distance has been on.
All right, testing, 1, 2, 3, testing, 1, 2, 3. G'day, mate. How are ya? How's your mum? Everybody alive? Okay, well, hopefully you're alive. I am, me too. It's 8:04 in the a.m., New York City, Wall Street, 8:04 a.m. The market opens at 9:30. But hey, we got things to do. We got things to plan for. We got to be ready, willing, and able. So thank you for being part of the Forex.Today YouTube community of 17,500 foreign exchange traders. Let's get on with it. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Welcome, welcome, welcome. I'm looking forward to another fantastic Thursday. We We got lots of economic data and fundamental analysis to be doing. It's also a good time to be setting up next week. Yeah, it's Thursday.
Comments from Fed's Brainerd.
Hang on. Where do I trade the news?
About climate change.
Okay, it's way over there. Anyways, yeah, what was I saying? Yeah, we got a lot going on fundamentally, and what you should be doing on Thursday is setting up next week's trades. Next week. We're already on next week. What are you still on today? All right. So anyways, everything about today is from yesterday. So today we're going to focus not just tomorrow, but next week, and maybe kind of look at the rest of the month. So I'm very excited about that. I always love Thursdays. Best trading day of the week, I think. Again, because it sets up everything for next week. Cool. Yeah, Jim's like already front running a couple. I mean, the markets are pretty good. Everything is right as rain. Good. So we can talk about that. So please ask questions, get involved, take notes. I promise to do my best to answer your question. I'm here every single day, so if I don't get to it today, show up tomorrow and ask then. So it might be a good idea to subscribe and then click that little alert reminder notification button, the little bell thing. Maybe give that a click. So I'd like to thank you for the loyalty that you show and the respect that you show me every day. I hope you feel good about being part of this community. I think it's a really good thing. I think we make the world a better place. Also like to remind you that you're going to need a broker one day, somebody you trust. I trust tradersway.com. Why don't you give them an opportunity to earn your loyalty and respect? Tradersway.com, open up a demo. It's what you see me use every day. So you'll see that the execution speed is fast. Swaps are amazing. Spreads are competitive. But just think about the attitude that they want to support you now while you're still learning, so that when you do become a trader trading with real money, that you have patience and discipline, perhaps even some skill. Think about that kind of attitude. Tradersway.com. So where are we? Let's just take a look at where we are in the world. Euro dollar. Everything's doing its macro thing. Really cool. I want to start out hot right off the bat. A couple of things you should be doing. I'd recommend while you're doing the Bank of England. Okay. Now let me pop down a link for you. I'm going to pop that in here. I was on this earlier today, just doing my stuff, poking around. Specifically for today, you should be reviewing the ECB meeting minutes that came out recently. Okay, you should be going through this. Yesterday, you should have gone through here. I like the HTML version. You could have the PDF version. Okay, and you need to do this. Okay, I'm often asked, Wayne, how do you do all this? How do you do this and how do you do that? And how did you come up with those opinions? I do the work. Nothing unique, special about that. I do the work. Okay. So Daniel says he's already spent over an hour. You said 3 hours reading the Fed meeting minutes. Cool. Right on. Okay. So it's 7:30. It came out. So like 45 minutes ago, that ECB news came out, and I'm sure you're already on it, right? Anybody? Who read the ECB meeting minutes? Okay. Now the FOMC meeting minutes yesterday, they noted that longer-term Treasury yields rose notably over a period. That means a lot. Okay, the yield curve is getting more vertical. It's been flat for a decade. It's getting vertical, which means people are getting out of bonds and into risk assets, and we're reflating the economy. But dude, you and I have been talking about that since April or May. So now it's seriously happening to the point where they're discussing it at the FOMC meeting. The pace of the recovery and employment had moderated in recent months, obviously due to COVID. Noted economic conditions were currently far from longer run goals, needed to remain accommodative until that is achieved, and that is likely to take substantial progress. Okay? And it's going to communicate these things ahead of time. Okay? Did you get something like that, Daniel? Ron took the limousine. Texas to Georgia, huh? Okay, cool. Right on. Well, how about the ECB? Okay. How about the Bank of England? How about the RBA? I hope you guys are doing the work. Okay, I hope you guys are doing the work. All right, cool. So last night there was a move here. Okay, telling sign. Then you get the lower low roll reversal, and then just not long ago, just it seemed like seconds ago. I guess it was probably 45 minutes ago. We had this roll reversal. Very cool, right? Some basic calculations will show you that you will earn 15% a month lending South Africa US dollars. Okay? Plus any asset appreciation. What do you think? Is that good? Obviously, that's leveraged, right? The thing is, you're earning 15% a month. So let's say not quite 200%, 180% a year just on interest only. Okay. Oh, Daniel, I posted the ECB meeting minutes above. Okay. Okay. What do you think? Are you guys going to be a financier? Okay. Now that's 15% IRR. So, for example, you could, this account's now almost 40,000, right? So you could put, over the course of time, 4 mini lots. Okay. Okay. But the thing is, with the leverage, right? You got to add a couple of zeros. I need more coffee. I need more coffee! Gee whiz. My Forex.Today cup is nice. It's just small. Okay. So anyways, Henry says try and hold that. Yeah. Okay. So this is going to be something that you might want to explain to customers, to potential clients or actual clients, that this is a part of the portfolio that you might be looking at. That you might want to consider adding part of that portfolio. Okay? Okay? Do you see that you could make a product of just this alone? You say, well, I'd like to capture some of this cash flow and the appreciation. This is a good income investment. Okay. Now, this gray area I drew a while ago, and I forget what it is, it doesn't matter. But you know, obviously, if I drew it, this is going to be interesting. This could be a challenge area, even for the bears, meaning like if someone was going to bring it up, they were going to do it probably now. Okay. And then, of course, bears are going to want to kind of play this next week. Right? Well, Steve, then you wouldn't be in the trade. Okay? But remember, the collecting interest or paying interest is based on the direction. So I am borrowing money almost for free from the United States and lending it to South Africa. So it costs me almost nothing to borrow this, and then South Africa is willing to pay a lot to borrow it. So it doesn't matter now if tomorrow this goes up. Okay, see my entry here? Every day, regardless of what is happening in the price, I will collect my interest. Okay? Doesn't matter what price is doing, I will collect my interest. Now, I'm giving up opportunity cost, right? So, for example, let's take a look. All right, I have 1,650 pips. And I've earned $4.75 in 10 days. In 10 days, I've earned $5. So I'm earning $2 a day. So you're like, whoa, but Wayne, you know, the pips are worth so much more, right? Actually, let's take a look. I didn't even look at the pips. So yeah, so $309 on a $100 investment. So who cares about the $5? Well, it's all perspective, isn't it? So it's the opportunity cost. But I'm talking about this part here. Okay, so like this one, I've been in this one now for a month, almost exactly a month. I've risked about $100 and I've earned $31 in interest. So I'm up 31% just in interest. So now I have to make the choice though. The pips are worth way more, but I also feel pretty comfortable earning 30% a month. That's pretty good. Okay. Now I know it's not really 30% because I don't think it's $100 margin. I think it's $120 margin. So, you know, we'll dumb it down. I think we said it's worth 250% a month, 250% a year. Okay. Yeah. Okay. Neat, right? So now you're going to say, wow, but Wayne, you know, the pips are a million times more. I know. But what was the logic? Right? The logic is what's going to be the most important part of your planning. Okay. So, for example, now that I've been brave, okay, here's an entry here. You see that? I entered it way over here. How afraid should I be that Eurozar goes up and knocks me out at break-even? No, I am not going to look at Swissy Japanese yen. Okay? Once again, those are both funding currencies, fellas. I'm a trend trader. I'm not a relative strength trader. I can be. I just don't like it because it's so backward looking. Macro fundamental trading is all forward looking. So, okay, let's say Swiss franc is strong right now and yet Japanese yen is weak. And we've had that kind of, but historically that just never really existed much. And so I don't even want to look at it, to be honest with you. Okay? I mean, honestly, I don't want to look at it because it might be awesome, but I don't want to trade it just because it looks awesome. Okay? Sort of like marrying somebody just because they're unbelievably attractive, and then you find out they're horrible people that are pleasant to look at. You're like, wow, Okay. HK says, I mean, you would still lose pips, and since the market is... Yeah, well, why would you enter a trade where you're losing pips? That doesn't even make sense to me, right, HK? So I would only take this trade because it was set up to fall, technically and fundamentally. Well, more like fundamentally and then technically. And then I added to the trade because it only makes sense. Look, I mean, dude, right? And then, of course, there's more and more and more of these trades, but like you wouldn't enter a carry trade in such a fashion that you would lose pips, right? Like you would never enter a trade that way, right? So you have to understand, guys, there's no difference in trading. I'm not like, I mean, put it this way, I'm willing to lose an extra $2 a day because I'm going to make that up in interest payments, but that's only 2 pips a day, right? So like it doesn't change how you trade, it only changes why you trade. Okay? So the why here is Rand is going to gain value. I was certain of it. Now, of course, I didn't know if it would happen, but I personally was certain of it, so I took a trade. Technically, it was a beautiful trade. The next one here is, dude, this is just a monthly swing trade. I would do this all day, every day, especially lower highs and lower lows, okay? This predicts an S2. That's why I didn't get out at M1. So I'm just kind of letting it do its thing. I'm letting it roll, right? But I wouldn't enter differently to say, well, I'm willing to go negative 200 because I make 2 pips a day. Well, that doesn't make any logical sense, okay? It only addresses the why I took the trade, okay? We talked about global macro recovery, economic activity expansion, global reflation. So now the Fed's talking about it at their meeting minutes like, oh my God, the 30-year bond is, the rate on the 30-year bond is skyrocketing. Well, I'm trading that right here. You have to understand, to me, they're the same thing. Put it this way. How do you get the rate, the yield on the 30-year bond to skyrocket to the point the Fed is talking about it? Well, what that means are sophisticated investors are dumping the 30-year bond. Why? Because it doesn't pay anything. Why the hell would you want a 30-year bond that gives you a 0 return? So they're not freaking out anymore. They're like, you know what? The world is good again. We got past this whole COVID nonsense. Great, let's move on.com. So they're dumping that. They're dumping the safety. That's risk on, bro. They're getting rid of their safety because they want risk. Remember, return is a function of risk. They're getting no return, so they're not taking any risk. But now they're like, hey, we can get some return, so let's get some risk. So they dumped the 30-year bond. What are they doing with it? They're lending the money to South Africa. It's common sense. Boom. Right? Now they're catching this yield. Now remember, the difference between you and I and, let's say, a more sophisticated investor is not trading 100 to 1 or 50 to 1, right? So a hedge fund, an aggressive hedge fund might be 4 to 1. So they're lending money to South Africa and they're collecting 4 to 1, not 100 to 1. And with that, they feel pretty comfortable that they're going to reach their 8% that their clients need them to make, okay? Okay? Okay. How much dollar per lot a day? So, the way I do things, guys, because it's so confusing, right? I don't count. In this case, it's still hard to count pips with low value currencies. Okay. So what I do is these are mini lots. So I have 3 mini lots. Okay. A mini lot. Okay. This is my mind here. A mini lot on the euro dollar is equal to $1 per pip, right? One pip. Okay. So I look at this. I'm like, all right, look, I'm up 731 pips. Now it's probably 7,952. I mean, because a South African rand pip-wise is nothing. It's like a fraction of a penny. So I just like, the way I calculate it is I just look at this and say, okay, this one trade is up 730 pips. The next trade is up 550 pips. This other trade is up 300 pips. Now, it's not really pips because I'm just equating $1 is equal to a pip on a mini lot, right? Every pip is worth 1%, right? If you make 100 pips, you've doubled your money, okay? So that's how, I know it's not accurate. It's just, who cares how many pips in that case? But I'm doing, I mean, you do care. I mean, I got to be careful. I'm trying to translate this to, you know, a unit of measurement that is equal across the board. So I'm kind of looking at it like an index, right? If this was euro dollar, if we priced everything the same as euro dollar, then as a function of return, okay, then they would be about that, okay? So that's not bad. So like, what's my internal rate of return now? Okay. What's my internal rate of return? Well, I have 342, right? So 342 divided by 1,635. Okay. No. Hang on. 1,635 divided by 343, I guess. There we go. So I'm up 477% internal rate of return. Hey, that's a pretty decent month, right? But that's only on 3 trades. So why am I doing this? I'm trying to show you. Go back to my message to you in January. Okay? Remember, this isn't how you trade. There's been well over 100 decent trades this year. Okay? So it's not like 3 trades is how you should be trading. That would be terrible. Ridiculously bad. But what these trades are representing is that you need to fold in long-term technical and big, giant macro trends into your trading. You need to learn how the market works. Stop chasing the quick buck. And I said, you're not going to be worth more, meaning you're not going to make more money as a trader just trading better, let's say, or more. More trades. I mean, you're supposed to be trading more than this, but what I mean is, taking what you used to do and just increasing that 10x doesn't mean you'll make 10 times more money. In fact, you'll probably lose everything. The next thing is you're not going to make more money as a trader by trading bigger lot sizes. Once again, that will lead to your bankruptcy. Okay? The way to increase your value, your worth, your return, is to have better trades that last longer. They don't have a 15-minute shelf life. I made 9 pips. Like, what the hell is 9 pips, right? It's to have more thought and more planning behind your trades so that the trades themselves are worth more. Okay? Many people here can't even think. Like, you were in that trade for a month? Yeah, bro. Right? I was long Apple computers for 27 years. I can be long the South Africa rand for a whole month. Now, how would I be able to do that? Well, I did deeper dive analysis and had stronger conviction versus, versus what? Reactionary or short term, you're picking up pennies here, picking up pennies there. There's a better way to hustle. Okay? Remember, we have to be street smart. We have to be savvy. We got to get in these trades. We need to be aware. The bigger traders, the bigger investors, they face their greed and their sloth. We have to be quicker and smarter. We have to be hustlers, right? But that doesn't mean stupid. Your trading should be worth more because your planning is better than the average Joe. Okay? You understand that? And so these are examples of 300 pips in a week. That's pretty good. But that's a basic swing trade. This is what we do on Thursdays, right? That USD ZAR. It's just a basic swing trade. There's nothing to it. It's not even that complicated. The only thing I got right was selling USD Rand. It's the only thing I did right. Everything else is like textbook boring simpleton stuff, right? I just happened to do it well. Good. Okay? But the planning is where I made the money. Okay? And the same thing with the other ones. They're just swing trades. But I had stronger conviction. So like the Euro ZAR. Okay? Now you can think of it. I told you when I took it, I think it's mediocre. Here's a way to look at it. That first trade I've been in for a month, 730 trades. The USD ZAR I've only been in a week, and it's almost half. You see that? Like after a month, only 700 pips? Oh my gosh. Well, I told you it was mediocre because the euro was going to behave in a certain way. So not only did I take the shot and was profitable, I told you why I took the shot, how I took the shot, and on top of it said it's going to end up being mediocre. Because you wait, maybe if things work, in another month will go by, and maybe my USD South African Rand will be up 700 pips, and that Euro Rand is probably still going to be worth 700 pips. So like nothing happened over a month. Yeah, except I'm collecting 30% return per month, risk-free. Or nearly risk-free, right? Except for a black swan event or something, right? Okay? Please book. You see, but I don't want to I don't want to take profit on a trade simply because I'm profitable. Okay? So this will be important, guys, down the road when you're trading bigger money. Okay? So I'm having a conversation with a firm right now where they gave me a contract and everything, $5 million. I'm like, whoa. I don't know what you need. I don't know what you want. I don't know your risk tolerance. Hey, we can trade money. I mean, that's fine. But there's more to it than just, hey, sit down, let's trade. How does all this fit in? What are the goals? What are you trying to do? What kind of clients do you have? What do they need? What do they need? What do they fear? Let's talk about it. Let's put some strategies together. Instead of 5M in one account, we can have 5 accounts with 1M in it, and this one does this, and this one does that, and we can spread this out. We can spread the risk out, but get better returns from each. So as a whole now, you would spread, that it's a form of diversification, but then through each individual account, you get more specialization. And when you study, oh, by the way, check it out. I got this in the mail from Harvard Business School. I am now an expert in alternative investments. Okay? Anyways. That's why I got my HBS sweater on, right? Anyways, so by diversifying, you lower overall risk, but then by specializing each account, the concentration produces higher returns. So higher returns individually, but lower risk overall. But I'm also concerned about their clients, like, well, what do they need? What do they want? What do they fear? How can we help them? Maybe not just a pure absolute return, but do they face risk in other markets? And then what else does the firm do, right? Does the fund also invest in the stock market? And if so, is it global stocks? Do they invest in commodities? Do they invest in bonds? What about the flow? What about physical gold? What about physical diamonds? Like, what else do they do for their clients? Because it's just too simple to say, here's $5 million in trade. I'm like, right? There's something bigger, especially if you want to find success and then go out and then bring in even more clients. I'd rather add clients, right? So it's like, it's too simple just to think, sit down and trade. And when you break down your logic this way, even if you only have one account and it's just for yourself, the logic of this trade lives and breathes on its own, independent of everything else. These had logical reasons. And I put those logical reasons and I put them there, and then I go to the next. You see? Then you go to the next, and the next trade could have completely different variables, completely different strategy, completely different focus. But what I'm also telling you is the worst thing you could possibly do is get out of a trade simply because you're profitable. Because this is what happens. Amateur traders, they don't get out of their losing trades, right? They're slow to get out of their losing trades. Like, oh, it might come back. It might come back. Oh, it might come back. But they're quick to get out. They're like, oh my God, I made 100 pips. Get out. Well, what the heck? You're up 100 pips finally. But nobody cares that you hit triple digits. Maybe it's actually a good trade. Maybe that's the one trade that'll go 300 pips. But you're so quick to get out just because you made 100 pips. But the focus is so backwards. If your trade is so good, let the sucker run, because you finally either got lucky and caught a trend, or you identified the trend was there. Remember, I want you to be Thor Heyerdahl. You spend a lot of time building a raft, and you build it as strong as you possibly can. Tie the knots tight. And then you get out onto the ocean and cross 4,000 kilometers. It was more than that, wasn't it? 6,000 kilometers of nothing but open ocean. And you arrive at the destination you predicted on the exact day that you predicted you would arrive. And you're just floating. Now, how the heck did you do that? You caught the current. This is what we're trying to do. I want you to focus on building rafts, aka planning and strategy, right? Focus on building the best raft you can. Float yourself out in the ocean. And if you catch the current, you're gonna reap the rewards. You don't want to end up out in the middle of the ocean with no current. You don't want to be going in the middle of the ocean going the wrong way, or even worse, in circles, right? So it all comes down to, can you build a raft that survives, aka your strategy? Do you have a solid strategy, right? And then, do you actually know where those currents are? Can you catch the current, and can you stay with the current? Okay? There's a lot going on here. Okay? So don't look at these as just trades. There's logic. Okay? Now, with that being said, and I think we were asked this, I guess Monday. Okay? Can I take profit there? Yes. Okay? The next part would be, when would you re-enter? Okay? Oh, right on, Maida. Thank you for everything you do for the community. Yeah, Brinsley's like, we want to book profits too fast. Yeah. And in particular, those poor traders that focus on winning percentages, it ends up creating a psyche of getting out of everything quickly. Just your winners, though, right? It creates a point where you're focused on winning percentage, not how much money you make. And that's a very dangerous thing, and it takes traders a long time to figure it out. Nobody cares about your winning percentage. What? Would I leave Forex? Of course not. Dude, no. That's not FU money. No. But even then, I would do this because it would help me, right? So anyways, no, I would not leave Forex today. Yeah. The winning percentage creates bad habits. In fact, if you have, I think it's important that you show potential investors that you know how to take a loss. To me, that's very important. You're like, hey, I was wrong here, so I bailed. That kind of attitude, like I thought about it, I planned for it, and it didn't work out, so I bailed before it was a problem. It's the best attitude you could possibly exhibit to a potential trader. If you read about anyone's experience of blowing up an account, and I don't mean amateur, I mean billions of dollars in an account. Think of like Ray Dalio. Everyone loves Ray now, right? Ray Dalio, right? They love him. Oh, and he's writing his books about how to, live your life. Maybe they're good, maybe they're not. But he is a good trader. I like his logic. There's no doubt. He's a macro trader with behavioral psychology. Okay, I like that. That's probably how I do what I do. Okay? But you have to understand, when he first became successful at with Bridgewater, he used his analysis to make a prediction. I forget what it was. Did it have to do with the Russian default? That might be long-term capital management. But anyways, he bet against something. He did all the analysis in the world. He did everything that Ray Dalio. Dalio? I can't say it anymore. Never had a problem before. Anyways, everything that you know about him, he used to make his decision. Okay? And it didn't prove out correct, so he traded more, and then he traded more, and he traded more, and he traded more, and he traded more, and he blew up the account. Because he was so focused on being right. It's not a good way to trade. You understand that? So being right is a horrible thing to focus on. Instead, you need to look at what is actually happening. This is why I say, when we go through our charts, doing our, like at the swing trading group, right? We always start with, what do we know? What do you want to do? And then what do we know? Okay? What do you want to do, Euros are? I want to sell it. Great. So what do we know? Is it bullish, is it bearish, or is it neutral? Well, we know the predictable pips have been made. We know that to be true. Okay? It could make a lower low, but it doesn't have to. Okay? Doesn't have to. So, should we bail? You could. If you did, it certainly wasn't the wrong decision, even if it made a lower low. The next big question is, are you still going to be a bear? What about the future? Check this out. Is that a role reversal you would trade? Does this signify bears that did take profit, did they re-enter their trade? Okay? And traders that missed this one, did they enter their trade? Like, is this a new point in the trend? Or is the trend over? Okay? Now, if you're thinking this way and asking yourself these questions, then you're doing the right thing. But focused on being right to the point you trade when wrong. Like someone else said, well, what if you're doing the trade but you're losing pips? I'm like, why would you be losing pips? Like, it doesn't make sense to me. If the trade has gone wrong, you're out of the trade. What did you lose? 33 pips? Maybe 50? Like, you're missing a point. Like, you're never allowed to lose pips. Right? You can get out of a losing trade. Okay, that's fine. But you wouldn't be in the trade anymore, so you're not in the carry, and I don't know. Anyways, it's funny. So You're always supposed to be in a winning trade. Okay. All right. All right. All right. All right. Let's shift. Let's shift. I got to move. Give me the juice. Okay. What do we know? Yeah, it seems to be trending bullishly. Okay, very good. Also, could you be trading this on a monthly basis? These are monthly entries, guys. So going back to December, or even going back further. Double bottom. Check that out. It's all highlighted on the first hour of the first day of November was a buy. And by the way, we were looking up. We were not looking down. Can anybody confirm that? There was absolutely no chance in our mind that this was going to fall. And that the only thing we were going to do with this is long. Okay? The only thing. We were going to buy it today or we were going to buy it tomorrow, but we are going to buy it. Right? And every single day, your decision was, should you buy it today? Should I buy it now? Should I buy it now? Should I buy it now? What about the market open? Should I buy it? What about the day trade? Should I buy it? What about the swing trade? Should I buy it? What about the position trade? Should I buy it? Should I buy it? And, right, the logical exit was December 18th. Dude, this is November 1. So anyways, we're talking almost 2 months there, right? And then what? Do we suddenly become bearish? No. The dollar will get strong. Okay? So this went up, it came down, it has come up, it has come down, it has come up, it has come down. And notice all of that part, okay? Because sometimes I'm not sure if you watched the day charts or the 4-hour charts. I don't know if you look at monthly pivots or if you're stuck on a 15-minute trade. But notice that this is an entry. Notice that this is an entry. Okay? And then this is OOP, so you ride the 4-hour 21. Can anybody confirm that? In a position where you're OOP, okay, you're going to buy the 4-hour 21. Can anybody confirm that is straight out of the training course? Factual, written down, talked about, discussed, rule of engagement, okay, fire for effect. And what's supposed to happen then? You're supposed to hit here. What are you supposed to do there? Well, this one's interesting because if you bought it here and you hit the target, I'm talking about time now, not price. If it does this, you're out. If it does this, you're in. I mean, you can get out, of course, but the idea is you don't have to exit. And check this out. This might actually be a March trade. Okay? We might already be in a March trade. You don't know. So what if you buy it today or yesterday and it does this? Well, you wouldn't be in the trade anymore. See, that's why it's always funny when somebody says, well, what about, would you still be making money if it was falling? I'm like, no, I would have got out way before, bro. Like, think about it. This is where technical analysis comes in. Okay? Where does this Fibonacci retracement fail? Okay? This is an in, and this is an out. Okay? So if you bought it at 76, your stop could be like 75, 60. Like you're risking 33 to 40 pips, maybe, God forbid, 50 pips. But imagine now you're in these trades for much longer than you're used to. Okay? And you realize 50 pips is like one day worth of trading, but you're in this trade for weeks, maybe months. So you're like, oh, well, all right, so it made a 786 and I got nervous. So I took some profit, especially because we kicked off the profit target. But like if you're really nervous, I would coach you to get out here and then re-enter here. That's how I would coach you. I think it would be terrible to not do anything at obvious resistance, wait for it to make a 618, and then you bail because you're afraid. That's nonsense. That's El Crapola. Repeat after me. El Crapola. Right? So anyways, right, if you haven't responded now, okay, so we're already on the next trade. So it's either going to do this or it's going to fail. So if it fails, what are you going to lose? This? Okay? Okay, and your major risk here is something I call fib wars, where it double tops and then drops. Well, in that case, you're out at break even. So here you are, you're under two scenarios. You're either going to lose 33 pips, which is a half of a day's worth of risk, or you're going to lose 3. Okay? In the failed trading, you're either going to A, lose 3 pips, or B, lose 33 pips. And if you're leveraged properly, it wouldn't matter either way. So there's no fear. You see, like, there's no fear. Okay? There's no fear. Okay? Like, you might have got knocked out of this trade here, and then you bought it back in here. You're going to get knocked out of trades, but you should do it well. I kid you not. In my book, I say you should take pride in your losses. That's much different advice than you must have an 80% win ratio. Okay. Leverage properly, meaning, let's go back to this and let's open this up. Okay. Let's say you lost 33 pips. Okay. And it was 0.1% or 0.3. Okay. 0.3%. Can you survive the loss? What if it was 0.3%? 0.3%. Can you recover from that? Yeah. What if it was a 3% loss? No, you're fired. That's baloney. It's so ridiculously sickening wrong that I couldn't look you in the face as I pushed it out the window. Hey, look at the pretty bird. Oh, he fell off the ledge. Okay. It's ridiculous. 3% on one trade, you're fired. I mean, it's so gross, right? I'd have to carry you back up and throw you over again. I mean, just to keep all the other traders in line. Okay. You're taking way too much risk. And that's why typically what I find is when people tell me, I have this fear of trading, I can't pull the trigger. Not always, but much of the time, it's because they can't afford the loss. Well, then you're so focused on other things, you're not even doing your basic job. Okay? Fear is healthy, but it shouldn't be paralyzing. If it's paralyzing, if the consequences are too high, like Russian roulette, fear should be paralyzing in that situation. Okay? But imagine now you said to yourself, okay, how about this? Okay, for you to lose 3% this month, you would have to lose, let's say, 30 trades. Okay, lose 30 trades, which means you could do, let's say, at least 60 trades this month. Okay, because your winning ratio should be, let's say, certainly 50-50, right? So you're like, well, typically, if at 50-50, you could have 30 losing trades, okay? But even then, if the other half, then you still would be profitable, right? So think of it like, how bad do you have to be to lose that many trades? Well, what if you lost 30 trades in a row? Okay? So now each trade is worth 0.1%, right? So 0.1% times your account size. And now you have to say, well, what's your average loss? Okay, so negative 33 pips equals 0.1% times your AUM. Okay, so now you'll find out when you do these calculations, you're grossly over leveraged. Okay, so I used to have a rule of thumb. Okay, I would trade one mini lot per 100K of cash. And many of you guys are doing one mini lot per $1,000 in cash. Right? 1K. So you're leveraged 100 times more. Now, is that the right answer at the top? It was for me in that situation. Okay? It was for me. I was also trading a lot more than you. Okay? 30, 40, 50 trades a day was common. So I didn't need much leverage because it all added up. I didn't need big lots because it all added up. Okay? So you might trade a lot less than me, and that's fine. And so now you're doing one mini lot per 10,000. Okay? And which is interesting because you're not actually using the leverage, but you are, because it gets you into a trade and then you let it run and then you jam another one, jam another one. So you might have a $10,000 account and you have $1 million in floating volume. That's the wonderful thing about leverage, because you add one, move the stop, add another one, move the stop, add another one, move the stop, add another one. Oh, you lost on that one. Enter another one. Oh, you lost on that one. Enter another one. Let it run, move the stop. Enter another one. Let it run, move the stop. Okay? And you're building it up. So instead of one standard lot, you have 10 mini lots spread over time and price. Okay? You see that? And all of a sudden now you can coordinate what you're doing, and every trade individually has a lower risk. And at some point, right? Like, let me try to examine it in a different way. Let's say I do a mini lot. Okay? I enter a mini lot and it takes off. And here I add another mini lot, it takes off. This one I get knocked out, -3. And then, right, and then I add another one. And then I add another one, right? And then I add another one. Every time I add, it's still 10,000 in risk, right? One mini lot. Well, no, it's $100 in risk, right? It's $100 in risk to trade 10,000, right? Oops. Okay. So how much am I always risking? If I'm leveraged 100 to 1, right? How much am I risking? Well, I risked $100, right? But how far was my stop? 33. So I'm actually only risking $33. Second one, I enter this one. This one's profitable. So when I take this trade, how much am I risking? Well, it's still negative 33 on the trade, but I might be up $100 profit. So I'm really risking 33 of the $100 profit that I'm already in. So I'm not actually using my $100 cash anymore. So I enter that one. And then I probably would enter one here, and then I'd lose. So did I lose 33 or did I lose 3? We don't know. And it comes all the way back down here. Okay? You see? But I'm still really only trading this original money. So I entered another one here, and then I enter another one here, and I enter another one here. It's just price action. Enter another one here, just price action. And then if I lose, how much have I lost? Well, now I got 1, 2, 3, 4, 4 trades open. This one gets knocked out. Let's say the full negative 33. This one probably only 3. Okay, so now I'm up this one, this one, this one. Okay, and I have the floating profit, but I still have never risked more than that first trade. Okay. Because if suddenly I see this as a top of the month, and let's say based on seasonality or some other sign, some other signal, some other warning, a change at the Fed, change in news, massive terrorist attack, something happens, and I'm like, give me all my money. Well, I'll probably be up 3, 4, so I'll have $600 profit, right? I'll have 2 or 3 losses. I'll have $600 profit on my initial $100, right? Kinda. But you might also, it'll add up differently because this will cost me $100 and this will cost me $100 and this will cost me, so I'll actually have 300 in, but a lot of it was taken off my floating profit. So really I have 300, let's say margin, right? $600 profit. Never really got any serious risk because I'm trading floating profit. I'm only risking opportunity, but nonetheless, I have $300 in, made 600, so my internal rate of return was 200%. But again, if you think of it from a different point of view, because I entered here and then this one was trading off that first profit, and then I lost 3 pips on this one, but I'm up 100 or more. So that really was a rounding error, right? The next trade did well. The next trade did well. So now I'm up 500 pips. What am I risking? I'm literally, because we're mark to market, that 500 pips or $500 is already in my account, and I'm taking a third shot. But I never actually risked more than that first stop of negative 33. So now you can maybe even justify and say, well, Wayne, you're up 600, but you only ever risked 33 and the rest was opportunity cost. So you could base your internal rate of return on this and it's thousands, right? That's the funny thing about statistics. You can just change the variables and get a better number. But my point is there's no need, if you're trading properly, to be over leveraged, meaning your lot size relative to your account size. And your account size, since we're mark to market, reflects your profitable open positions. Are you allowed to have a negative position? Hell no. Ever. Yeah, you can have a losing trade. Yeah, okay, you lost 33 pips. But like anything beyond a trade that didn't work out is unacceptable, right? And so going back to answer that question, like, well, Wayne, you're doing a carry trade and you're earning 2 pips a day. Am I allowed to be negative 300? Like, no. And by the way, you would be short in a market that has clearly turned the corner. Like, you're still selling in something that's rising. Like, you're missing the point. Like, you don't get the concept, or maybe you do. But this idea, like, if I'm short euro ZAR, it's because I think the market's falling, and technical analysis has confirmed that it is indeed falling, and I'm selling higher, lower highs. And I'm profitable because of that. So there's no way I would be losing the money, right? Like, it wouldn't make sense. It doesn't make sense in that situation to be losing. Okay? You see? Yeah, FIFO, yeah, I don't want to talk about FIFO. Okay, so anyways, I got to save some of this. I should have done that with just the swing trading group. That was a lot of value you just got there. So I'm going to pipe down. I got to hold back some. Cool. So yeah, so anyway, swing trading group, we are meeting today at 2 p.m. ET. 2 p.m. Eastern time. Okay. So I hope to see you there. And just a reminder, if you didn't catch it, I added the macroeconomic courses to the War Room playlist. So you have video 1, 2, 3, and 4. Okay. Lecture 5 kind of looks like that a little bit. You know what I'm talking about? Yeah. Okay. And that'll happen next week. It's $1,000 a week, but it's on sale for only $100 a month. Yeah. How can you access those courses? Well, if you're a member of the swing trading group, you just go in the War Room playlist. If you're not in the group, you have no access. If you want access, you join FX Bootcamp. But HK, I think you're in, aren't you? But if you're just in FX Bootcamp and not the live group or the professional track, right? Because we have dozens of people learning how to be portfolio managers, right? Yeah. Yeah. So if you're in my swing trading group, just go into the War Room playlist. They're all there. Just click the button. Turn your volume on. Okay, let us go. Oh, well, refresh your page. Well, you know where the playlist is, right? Well, how about this? Can anybody confirm that they can access the macroeconomic course videos, the lecture videos in the War Room playlist? Can anybody confirm that they are indeed there? Yeah, they should all be there, but in lower, I don't know how it adds it, like in order or by date or whatever, or by title. I don't know how it actually does it. Okay. No, they're all there. So I don't know how it does it. But I did the same thing for 4 as I did 3, 2, and 1. If not, I'll take a look later today. All right, so Bitcoin, okay. Bitcoin, unbelievable. It's crazy. Who would have ever thought? Oh my God, it's unbelievable. Yeah, so that's what we planned out weeks ago. Think about this now, guys. We said 52,570. Can you see that? On February 1st. Okay. But this had to do with going farther out, so I should be careful. But yes, anyways. Yeah. Anyways, this had to do with a couple of things. Anyways, we hit the number, and great. So what are you going to do now? Some of you say it's going to be, that it's on its way to $100,000, and other you guys say it's going to drop back down to 30. Cool. So right now, what this shows is, maybe like this and like that. Okay. Right on, AM. Thank you. Okay, good. So all 4 are there. That's good. Oh, but Matus is only 4. All right, I'll look at it. I'll log back in. All right. I. So we're in the best trading period of the day for oil. So the only thing that matters is whether you are a bull or a bear. Oops, I didn't mean to do that. Let's leave that there. Okay. This is the hour of power when it comes down to oil. Okay. Okay. Well, my trading account behind me keeps going offline, but this one stays. I have to check the rig. Should be enough. A little slow, but it should be enough. I don't know why it's having so much trouble. If you're not sure of what I'm talking about as far as the best time of day to trade oil, you should search your notes, would be my first response. The other thing is, I made a video 2 months ago, 4 months ago, on how to trade oil. It's probably longer than that. Let me try it. youtube.com/Forex.Today. Trade oil. How to trade oil. When, how and when Forex traders should trade oil. WTI, oil trading strategy. Cool. Nice, right? It's funny these guys went out of business, huh? That's actually pretty cool, huh? I don't get to watch my own videos. Oh yeah, that's the June Fed meeting. Very cool. Where am I here? That's where I'm in Tennessee, isn't it? Yeah. Yeah, that's when I was moving all the screens. It's interesting that these are not in order. Remember that intro? That was great. Sorry, just I'm off in La La Land. Oh, look at that. But here it says, do you think Texas, does taking 40%, like think of the question, right? Does taking 40% of the United States oil production offline impact oil prices? Yeah, of course. Oh, sorry, man, I missed that. Yeah, just trade oil. Type that on, on trade that. Type that in on the YouTube. Okay, there you go. Thank you, Daniel. Anyway, so there you go. This is my favorite time of the day to be trading oil. What do you think so far? Okay. So, really, you should be on at 61. Simple price action, especially if you're already a bull. Then the second chance was this one. And do you know if it's going to go up? No, that's why this is the better trade. Because if bears are going to fib it this way, that's part of the fib wars idea. So bears are going to take it high off of, they don't want it to get to 62, so they're going to sell it at 61.80, maybe even now, but probably a little bit higher, right? So they'll probably do this. You just have to understand your market. Okay? That's why, like, it's pretty late. This is the right time of day, of course. But you probably should have bought this at London Open on the roll reversal, jammed your stop, and you're done for the day. This is the important part of market open stuff. You know, when you're in our group that's learning how to be portfolio managers and entering trades and stuff, it's so important to know when to trade, because then you're done. Instead of watching the charts for 7 hours, you watch them for 1 hour. And then you're like, oh, there's my roll reversal. And then you're done. Like, what did you do today? Oh, well, oil is bullish. So I bought it at the roll reversal at the market open. And everyone's like, oh, well, that makes sense. Okay. Well, Jeff, watch the video. Watch the video where I explain exactly how to set this up. And I did that, I don't know how many months ago now. Okay. The bigger thing, Jeff, is it doesn't even matter what strategy that you really use or what technique. Most people just don't do it. That's the biggest thing holding people back. They just don't do it. Did you read the ECB meeting minutes? No. No. Did you read the RBA meeting minutes? No. Did you read the Fed meeting minutes? No. What prevented you? You know to do it. I say week after week, month after month, year after year. Yeah, well, I just didn't do it. That's the biggest problem, I think, in most cases. It's that you're completely capable, but it doesn't happen, right? So the same thing, like I've done so many of those videos on how to trade oil. That could be the one thing that you do, and if it was the one thing that you were doing, you'd be doing it certainly better than I could because you're such a specialist, and it could be your one thing, right, Jeff? It could be your one thing. That's what you do day after day after day. You buy oil in an uptrend. There's no problem. There's no trick. It's not like after the fact. Oil's going up. You buy the dip. It's price action. You bought it at 61 at London Open. Why? Because you're a bull. Why? Because of the macros. Why? Because of the trend. Like, there's no complicated part to it, right? So it's not me going back saying, well, because of my magic, I know what to do. No. It's just these things we do every day. Okay? I recommend, too, that people don't try to do everything, but instead they specialize. So if you want to be an oil energy complex trader, then you'll get that. Dude, this is an uptrend. This is a role reversal. That's called price action. It's cool. Not complicated. And of course, if it makes a lower low, you're done for a while. Whoa, back off. So it's not hindsight, Jeff. La 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 la. All right. Yeah, let's do yens. You're right. Let's do yens. Yeah. Yep, Daniel, if that's the only thing you did, you do well. Okay. Let's talk about buying. What do buyers do? So buying started way down here off the screen. Okay. Riding the 21, which means we're extremely bullish. Okay. In fact, we opened out a position. We hit the target early in the day and it counter trended. Great. Okay. Up, down. This one failed yesterday. Look, it failed, eh? Failed. You had a losing day. It's all right. So here we go. The next day. The question is, you lost money on Wednesday. Okay? You lost money on Wednesday. Is it all over? Are you throwing in the towel? The fundamentals have radically changed? Probably not, right? So this is a buy zone. And what's next? Here you go, Jeff. You ready? Okay. That's an obvious plan A. Okay. You might get this later today. Okay. You might get this today. Okay. The next part is plan B would be kicking it off of the 21. So now we have to project forward. And that would put us out of position. But I'm okay because we're going to predict that in advance, Jeff. Okay, we're predicting tomorrow now. So let's predict an out of position trade. Okay. Let's do the 21. Shift that sucker 4. Make the visualization. Here we go. No, I want to do it like this. Even fatter. Okay. That doesn't look right. Is that 55? Did I miss something? Input. 21, 4. Doesn't look right. What do I have wrong? 21, period, shift 4. Yeah, it has to do with how much damage is done. Okay? Remember, Japan gets earthquakes all the time. People have to be forced to bring money home. So a large part of the population will have to face financial distress. Yeah. The other thing you should do after a giant earthquake is you could look at large publicly traded construction companies that are likely to get government contracts to rebuild buildings and roads and schools, power plants, that kind of thing. Okay, so also put that on your list. So what you'd want to do now, Johnny, is figure out what companies those are. Who would get the big government contracts for cleanup and rebuilding? Because I'm telling you, you log in the next day and it'll already be over. Those stocks will be up 20%. So it'll be the first one to get there. So anyways, I'm looking at this and I don't know why. Custom indicator, 0 lag, moving average, shift. Is it supposed to be a -4? I thought it was 4. Oops. That's definitely not it. Huh. Maybe it'll just catch up. I don't know why it's 4. Why it's lagging. But anyways, I guess it'll just catch up quicker. It's interesting. Yep. I guess it'll catch up quicker. So what'll happen is this will skyrocket faster to provide this. Now, if we kick off the future 21 EMA, which would be tomorrow, by the way. So, for example, let's get even more specific. If this drops today, meaning like during the New York session, so let's say at the London close, the London boys go away, this drifts back down, Americans kind of bring it down, and then maybe at the U.S. close, this starts to rise. That's one trade. That's called a front run. The next trade is more like an Asia Open, London Open. And that will be where this comes up like this, okay? And the next version of it is that means this continues up, doesn't come down. So this right, the first one doesn't happen, but then you find yourself here at the Shanghai Open or something, okay? So there's two trade plans here, Johnny. And this is not Johnny Muff. This is Johnny, the other Johnny. Sorry, the other Johnny. Yeah, I guess too many. The chat's moved since I looked. To the Johnny that it says it's easy in hindsight. So I'm planning tomorrow. And there's the plan A. Oops, plan A is going to be the pullback to the buy zone. So we call that a front run. Plan B, because we don't know the future, so we have to have contingency plans. Plan B, well, we don't get the pullback for a front run. It does rally up and hit the target for the day, stays elevated, waits for the moving average to catch up, so then you buy it off of there out of position. So an OOP means we'll head up here and we'll probably get close to 49 or 50 tomorrow, in which there'll be massive profit taking, probably before New York opens. Oh, it wasn't John, it was Jeff. That's right. Jeff Bick, I think it was. All right, cool. So yeah, so Jeff, I hope that something of that helps. Okay. My intent is not to show you trades that have already happened. You should have seen some of these trades yesterday. Okay. And so now this is how I'd literally plan tomorrow. I would do this. This is what I would do. I would buy it down here, or I would buy there. This one, I'd let it run. This one, I'd probably take profit earlier. Okay. Okay. Now, the biggest question to continue, okay, to continue with the thought process is what do you want to see happen for next week? So I'd go swing trading bullish. I am a bull. Okay. And you'll see that this move was actually a front run already for next week. But once again, you probably already knew that. So that's how I'd incorporate that into today. Cool. So, yeah. Very cool. Very right. Very nice. Our potassium is superior to calcium potassium. Jeff, are you still here? I don't think I cursed. I said our potassium is superior to calcium potassium. He's on his Jeff. No, that's Jeff Bond, I think. What was that guy's name? Turns out that's not his real name. Really? There he is. Yeah. Oh, good. Right on. Oh, I know, it was Jason Bond, wasn't it? Yeah, that wasn't his name. It was Jason something else. All right. Yeah, gold. Yeah, gold. Yeah, gold. So what do you guys think about, we can go to the gold. Gold, is it central banks now unwinding their purchases from earlier in the year? What are your thoughts on that? Okay. Okay. Remember, much of this rally was central banks buying. Okay. This big move here was central banks buying to weaken their currency. So they gave up their currencies, put that into the interbanking system, and they acquired gold to put in their vault. Brian's like, is the reoccurrence of front running indicative of a frothy bull market? No, it's just trend trading. Could front running be used as leading indicator? No, leading indicators get you into front running. Okay, so let's see if I can use this as an example. I don't even know this one. Let's do position bullish. Oh, those are position. All right. So, all right. A dangerous trade. It's a dangerous run, right? This is dangerous, but I'm just trying to use an example. If you wanted to be a bull on gold and you're playing the double bottom and you wanted to use a leading indicator like next month's pivot points, Okay, we're talking about March pivot points. It's only February 18th. But if you were going to front run, you would be buying in this zone. Okay? Because this is the March buying zone. Now, it's also a double bottom. And if you're fundamentally bullish, because remember, we expected the dollar to be strong since January, right? So where is that? Since January, first week of January. All right, so since the first week of January, we expected the dollar to be strong. So dollar is strong relative to gold. We don't know if it's indicative of other things. It just is. And maybe that's just luck. Maybe this is just central banks unwinding what they did before. I don't know. It doesn't matter. Okay. So now you've made a decision. Okay. Maybe Jeff Bick is a buyer. Okay. Doesn't mean buying today is a good idea, although you could on the pretense of a double bottom. Cool. Now, let's zoom in a little bit more. I just want you to focus that we're looking at pivot points, monthly pivot points, 2 weeks in advance. Okay, so now you're saying you have the right price. That's all we know right now. We don't know anything else that except if you're going to be a bull and you're front running March entries, you have the right price, but now technical analysis is going to be used to determine the right time. The right price we already have figured out. It will be the $1775.55. Okay? So now the time is going to be based on your risk tolerance of when do you believe a trend starts to be bullish. Because remember, if we can start creating smaller trends up, then we are creating the double bottom. We're confirming the double bottom from months ago. And we're waiting for traders to catch up with our March trading plans. So if you waited and did all this, right? If you did all this now, that you believe you have the right price, you're waiting for the time, and when you make the decision on when to pull the trigger, the time, then if you got it right, it could be worth a lot. Okay, do you understand? This goes back to the sort of the value or worth of your individual trades. At the very bare minimum, currently, if it does something like this, the March target currently is 1990. But you also have to understand that if we close higher, this central is going to move higher, this bottom is going to move up to here, and these targets are going to move higher, and you're probably going to get closer to 1950 as a target. Okay? That's just front-running March pivot points. Now, let me give you some more juice. What if this was more than a technical trade to you? What if it was more than a double bottom, but you looked at what the central bank wants to do with the dollar, aka monetary policy, and then you look at what other central banks around the world want to do with their policy, especially if the dollar weakens? What would happen to their currencies relative to the dollar? Well, they might want to try to do the same thing. And one mechanism for a central bank to lower the value of its currencies relative to others is to trade out their currency and buy in gold. So now you say, well, wait, hold a second. If you go and do all this work and you decide to buy a double bottom here and you get, like, let's say this week and next week correct, the next week we'll have a higher high, which then confirms the double bottom. So then you can buy a higher low. Now you got this new target. But what if you're not just technically correct, but what if you're fundamentally correct that the dollar will continue weakening at least until the June Fed meeting, right? And then what if other central banks indeed do buy gold to devalue their currency? Well, then you got a couple of other reasons besides what you see in your chart that could make this pair continue to go up. So not only are you deciding for today and next week, and really next month, you might be able to hold this trade for 6 months to a year. Well, that's a lot of potential. But we don't know if any of it is realistic at the moment, because all we're doing is we simply have a price. But we don't have a time. But imagine you had price, time, and strategy, what we call fundamentals, the macroeconomics. Okay? What if there's just simply an increase in consumption? The consumption of everything goes up, including gold, which would then also weaken the dollar. If central banks step in, that would push up the value of gold because they're fighting the weak dollar, which you're already trading. So demand for gold then goes up because of central banks, but demand for gold would go up just based on global consumption. And all of a sudden, you got all these forces working for you, and you find out your raft is on a current. So this is why when I look at this, I don't look at it necessarily like, what should we do today? But how does today fit in this week? How does this week fit into the rest of the month and next month? And if you got that right, is there a reason that you got that so right? Okay? So I've been telling you, I believe the dollar will get very weak between now and April 1st. And probably several weeks before April 1st. So really, you could say in the next month. So it's the 18th of February. By the 18th of March, the US dollar could be weak again. Well, I'm incorporating that thought process here. Now, I don't know if it'll happen, but I'm trying to incorporate all this because if I get it right, my trade will be worth more. Not that I traded more or I traded bigger, but I would make more money because this analysis was so well thought out that I knew enough, I had enough conviction based on my thesis, my investment thesis, that I have the guts to let it run. So it's very, very right. And of course, either on a daily basis, weekly basis, or a monthly basis, you add to it, you add to it, you add to it, because revisiting the other part of our conversation today, I'm trading the bank's money. I'm trading opportunity cost, but my original AUM is already higher than when I started. So I'd have to lose quite a bit to get all the way back to where I started, which would be having lost nothing except the opportunity. Okay? So that's how you put that together. Okay? Well, yeah, so Brian's like, hey, well, maybe you're looking at it as being bullish because of well, that's the thing. Like, in sort of the development of alpha, some traders are trying to be smarter than everybody else, which means they see maybe what everyone else sees, but they want to be then in before what everybody else does. They're trying to get some sort of first mover advantage. Okay, Brian? I don't necessarily agree with it, but they're trying to get ahead of everybody else. So they have their own reasons, but they're taking that shot. Because if you know, like, think of it this way. I mean, most retail traders, they're stuck on a 15-minute chart. There's no doubt. But there's other market participants looking at gold right now thinking they want to buy it next month. They've already made the decision. Good, bad, ugly, doesn't matter. They're buying gold next month. And they're trying to decide at what price is a fair price. Not even a fair price. What price is a good price? And then why are they buying it? To be in it for 20 minutes or to be in it for 20 months? Maybe they're getting rid of their dollar to buy gold so they have a physical asset. Cool. Well, then dollar would weaken, gold would go up. So like, if you have strong enough reasoning behind what we're doing, you might say to yourself, well, I'm going to buy this gold. I'm going to get a good price. I see other reasons why other market participants will buy. I'll jam the stop, and I'll come back in 3 months and see what's up. See you in June. Okay? Now, if you ask me, if I had to throw down a guess, I would say March is the ugliest month of the year. So I'm ready to be wrong, but I'm trying to be right. That's the mental attitude. Okay? So, we have the right price. What are you going to do here? Well, we can do it. Let's get into the weeds. Okay? Put your waders on. Put your rubber boots on. We can go into swing trading bullish. Have to back out a little more. Okay? There's our swing trading price for Monday. So you might say to yourself, wow, okay, this looks scary in the moment. It does. Don't worry about it. If you're right, it will do something like this. 1, double bottom. Okay? Oh, let's do this in a different color. I didn't mean to do that. All right, let's start again. Okay, if it does this, okay, so let's do a different color. 1 is a double bottom. 2 is a higher high. And then 3 is a higher low. And you're long there. Okay. I'll put a little orange center here. This is where you're long. Because now this double bottom is a double bottom of a double bottom. It's just the right shoulder of a double bottom on a daily, but it's a double bottom on the smaller time frame, which is a 1 hour. But it confirms that you're front running next week and next month off of a daily double bottom going back 6 months, and that there might actually be fundamental reasons for this change in direction or a change of trend on this time frame from down to sideways to then up, which creates what you see here. Most likely then on a daily chart, you will get a 1, 2, 3 there. But on a higher time frame, so now you'll get a double bottom, higher high, higher low, but it's going to be from now all the way up to the June Fed meeting, and then all the way down into late summer, and then it'll start its rise, and you'll be able to buy it again and hold that to the end of the year. Okay? So Brian, the interesting thing is when you were a member of FX Bootcamp 15 years ago, we were doing this, but we were focused on the 15-minute chart, right? And we were focused on pivot points and market open volatility. So all that stuff is the same stuff that we teach now, right? So nothing's changed in the 15 years, except now we're looking at that higher time frame to set the direction, not for the day, but really for the year. I have a 5-year outlook, right? And then drill down, drill down, drill down, drill down, drill down, drill down, right? So it's cool. It's just maybe instead of, I think what I used to teach was bottom up, and now I'm sort of doing top down, but it ends up being the same thing. Okay? The major change since when you remember back in 2006 or whatever, the volatility has changed. The volatility has changed. There's twice as much money, probably 10 times more market participants. So these radical moves we used to enjoy, okay, the radical moves are gone. So all the lines are smoothed out now. Okay, you're not going to scalp retail sales and make 200 pips on a scalp. Those days are long gone. So it sort of forces you to focus top down now, where in 2005, 2006, 2007, we'd get a day trade, drop a lot on the euro dollar, and an hour and a half later be up 200 pips. That ain't going to happen anymore. Okay? Even non-farm payrolls only moves the market 40 pips and not 400 pips. So that's the major change, which forces you, because, see, before you could have this great strategy, but the tactics, you could gap you 200 pips, could pop you 200 pips one way or against you, and all of a sudden you're like, oh my God, I'm down 200 pips. So you would have to focus bottom up to manage the volatility risk that was present those days. Well, that doesn't exist anymore. So now the way to improve is to say, well, nothing surprising is going to happen today. Like, seriously, you don't get any reaction like that anymore. It's just like, today is just part of the plan, and the plan is certainly bigger than today. Today is just one data point in a trend, in a data set that we're developing, right? So like, today, don't worry about it. Today is no big deal. Nothing's going to happen today, really, except it's going to come out pretty much as you would expect. It's going to either be part of the trend, or the trend is overdone and it's going to have a cooling off period, and then we'll get back to doing what we're doing, right? So, but therefore, the analysis has to switch and say, well, okay, great. If today in of itself is probably irrelevant, then where is it that we're going? You have to first know that. Where are we going to be in a week? Where are we going to be in 3 weeks? So if we can get that kind of figured out through logic and such, then we can say, well, good. If we're going there, are the market conditions right now or today favorable to where for trading, right? Based on where I think we'll be in 3 weeks. So let's say in 3 weeks, I think gold is up. Should I be longing it today? I already know I'm a buyer, right? Think of it that way. I already know I'm a buyer. I want to be long next week. I want to be long next month. I want to be long maybe all the way to June. Great. So what about today? Should I buy it here? Well, it's the right price, but it's the wrong time. So I'll pass. Oh my God. What an amazing way to trade. It's extreme boss mode. I am going to buy it, but not under these terms. You see the degenerate gambling, like, oh, I bet you this will hold. It's a double bottom. I'm supposed to buy it. No, you are not. This whole down, like, oh, it's a double bottom. Buy it. Why do you think gold is going to go up? I don't know. It's a double bottom. You're like, oh my God. Oh my God. People are trading because it's a double bottom. Well, here, let's take a look at a double bottom. Okay? You're going to buy that? Well, what if it does this? Oh, you lost money. It wasn't a double bottom at all. Right? There's a big difference between this and this. So I'm like, you could, because if you're certain, and you get the right price, remember, the price is the double bottom, okay? And if you get it right, you'll get paid. But it's still a bit of a gamble. You're like, I bet you it'll go up from here. Why do you think it'll go up from here? Oh, I got all these fundamental reasons. Okay, cool, but it's still a little bit of a bet. At the very least, right? At the very least, you can afford to wait for something like this. And for most people, they don't even do that. Okay, they're already in. And you're like, whoa, dude, whoa. Cool off, man. You're coming in hot. Coming in hot. Right? So wait. Okay? Now, the best way to cheat the death here, right? Like you really want to throw some money down on this double top or this double bottom. Let me show you how you do it. You scalp it. You scalp into your, right? The reason for that is if you're wrong, your stop's going to be so close it won't matter. So now you trade on your 5-minute chart. Even your 1-minute chart, okay? I spent a whole year trading a 1-minute chart, okay? So now the issue is if you can get this to turn on a 1-minute chart or a 5-minute chart, jam your stop, right, from negative 33 to negative 3 and let it run for 6 months. Why? Because you might actually be right. Only scalp in, but you swing out, in my opinion. Because if you took all that risk, you're that ballsy, you're like, I'm going to drop a lot on this. Boom! Holy smokes. You were coming out guns blazing. But you got to make sure the risk-reward ratio is proper. Like, if you're coming out like betting on a double bottom, then at least understand what a double bottom predicts. A reversal. Which means if you were that aggressive and you dropped into a 5-minute chart and made a decision here, well, then it should make a higher high. Otherwise, why did you trade the double bottom if you don't expect the higher high? And if you get the higher high, then it's going to make a higher low. And then it's going to make a new higher high. And then it's going to make a new higher low. And then it's going to make a new... Like, dude, why don't you just get paid because you took a big risk? So therefore, to justify that nonsense, you got to get paid. Okay? Otherwise, you're just a degenerate gambler and you're going to gamble your way into bankruptcy anyway. So you got that one right, but you didn't get paid. You're going to get the next one wrong and you will lose money. Most likely you lose more than you make, so it doesn't matter. Go ahead, do whatever you want. It won't move the market if you go bankrupt. Market doesn't care. Okay? So I'm spent. So I will see you guys at 2 p.m. if you're in my swing trading group or if you're in my professional portfolio manager track. I will see you at 2 p.m. Eastern time. If you want to join the group, got to go to fxbootcamp.com. Pay for the courses. The courses are currently almost 80% off, so it shouldn't be a big deal. And then it'll ask you, hey, are you ready to join the live trading group where we can discuss the tactics you're learning in the videos, but we can do it in a group setting. We can do it in the live market. We can plan out trades, all that kind of stuff. Great. Pay the $99 and you're in. And right now I'm doing a macroeconomics course, and that's included in those groups for free because I'm the worst salesman ever. Great. Other resources are available, like my chart templates, books. If you need a broker, please choose tradersway.com. The links are in the description below. And if you're not in those groups, if I'm not going to see you at 2 p.m. today, have a wonderful day, and I will see you tomorrow at 8 o'clock Eastern time once again. So thank you for being on my team. Thank you for your positive energy. Thank you for the hard work that you do every day. Peace on earth. May the pips be with you. May your profits be above average.